Hey, welcome back. My name is Rick Bosley. I'm the team leader of the Bosley Team and 3L Coaching, and I'm here with you today. Thanks for watching this video, this email on YouTube. However you're watching it, we appreciate it. And I say we because we have a guest here today. Guest is a longtime professional in the mortgage industry, Michael Smalley. He's been doing loans since 2002. A couple different companies. I say a couple because he sticks with a company for at least a good 10 to 15 years, and he's most recently partnered and joined up. He's a regional vice president with CrossCountry Mortgage, the largest direct retail lender in the mortgage space. He's also still very active as a loan originator. And I'm bringing in Mike because I respect his thoughts, his processes. We've done business on and off for the last 15 years when I've been doing it, whether it's through some of his originators, as he was a former partner of a previous company. Every Monday he does a market update. He does a Zoom, and he mentioned a couple Mondays ago of the pending recession coming in and how does that impact affordability? How does that impact interest rates? And if you watched our last week's video or some of last week's blog, we talked about affordability being the biggest crisis or hindrance towards home purchasing. And we are above 6.5 months inventory right now when you look at the inventory. And I say inventory like it's musical chairs. And that's a little over 12,000 homes that are available for sale in Orlando, and a little less than 2,000 homes every month that are selling, which gives us an above 6 months, which technically that puts us in a seller's market, which might see a decline in prices. Now, seasonality is on our side, and interest rates are on our side, and we're going to see what the market, what the economy, and what we're seeing in terms of GDP, unemployment, inflation, recession might have to do with it. So I'm just going to bring you on now, Michael. You heard the intro. Did I get all of those stats and figures pretty correct there with my intro for you?
You are right on. You obviously have done this before, so appreciate the great intro, Rick.
Perfect. Good stuff. So Mike, I mentioned before, we know what we're talking about, but this is a very organic conversation. And if we've got some consumers listening to this, whether on your platform, mine, whether on podcast or YouTube or via email, we want to give them a little bit of insight of what's happening with the market, with the economy. Maybe we'll even have some tariff talk or some Doge talk, because that's going to impact it with what's happening up in Washington, D.C., what's happening up in Tallahassee, and how does that trickle down to our economy and our real estate industry here. Like I mentioned, you do your Monday morning market update. So a little bit might be an encore for you from this morning, but kind of just kick us started of what are you seeing that's happening with the market on a global scale, on a statewide scale, and how is that going to impact us here as we approach the second quarter of the year?
Yeah, so appreciate you having me in the platform. So, I think, Rick, there's so much information out there, and some of it is skewed one way, some of it is skewed the other, some of it is accurate, and a lot of it is inaccurate. And I think, for people like you and I, our job is to give the facts to our customers so they can make wise decisions and point out maybe what's incorrect information. And I think it's important to talk politics. I think people say, don't talk politics. No, you have to talk politics. You can take your, I voted for this person or that person hat off, but you have to be able to talk about policy, and you have to be able to take your glasses off of who you like and who you don't like and give your customers the facts, because no matter who you voted for, every 4 years, there's a new administration, and understanding what happens and what policies are likely to be put forward is important. Our customers don't care who you voted for. Our customers care what the market means for them today. So here's kind of where we see things big picture. I'm going to share my screen here, and I've got a couple of charts and graphs that I think are helpful. So I'm going to share a screen, Rick, and we can pull it up here.
I'll let you know.
And so here's what's happening right now politically. Okay. So as a country, we have a debt crisis, and we have a debt crisis twofold. We have a public debt crisis because we have $35 trillion in debt, which everyone who's watching this knows that's not sustainable. We also have a personal debt crisis because we have inflation, thankfully lower than it was a few years ago, but we hit 40-year highs of inflation. And so there's a personal debt crisis in a sense that consumers are feeling a pinch. They're feeling a pinch with mortgages, which is what I do, on their credit cards and their car loans, and businesses are feeling a pinch because they can't borrow money cheap to expand. And that debt crisis, in both political parties are at fault. So it's not a Republican or Democrat thing. They both have spent too much money frivolously for 40 years, and it's coming to a head. The you know what is hitting the fan pretty soon here. We're spending $1 trillion a year just in interest, and that's going to go to $1.5 trillion. We already can't afford $1 trillion. That's going to go to 1.5 trillion. And the way government debt works, it's not like mortgages where it's a 30-year fixed. You lock it in, you set it and forget it, and it's done, right? It resets every 2, 5, or 10 years. And so the chart I'm showing you guys today shows the $35 trillion of debt we have, when that debt matures, meaning does it have to be refinanced. And $9 trillion of that debt matures this year, most of it in the first and second quarter, and the first quarter is almost over. So that's really scary. If the debt matured at current interest rates, the debt service would go from $1 to $1.5 trillion a year. And again, $1 trillion of interest we can't afford, yet alone 1.5. So here's what I think the administration's trying to do. I mean, it's really interesting because, Trump's first term, it was very, look at the stock market, give me high approval ratings, right? And Biden was the same way, right? No matter what the unemployment rate or job statistics said, it was like stock market's at all-time highs, be happy, your 401k is doing well, right? And so now what's happening is Trump is less focused on the stock market and he's focused on debt. I think he could do a better job of laying out to the public what they're trying to do. If I was president, if it was Mike Smalley or Rick Bosley administration, I would come out and tell the public, here's the cold hard truth you don't want to hear. We have a debt crisis. We have to bring the 10-year treasury down. We have to bring inflation down. Whatever happens as a result of that, it doesn't matter. If the stock market goes down 20%, it doesn't matter. The debt has to come down first. And so I think what their goal is, whether that's increased energy production to bring oil prices down, which brings inflation down, the DOGE spending cuts, whether you agree or disagree or like how they've implemented them or don't like how they've implemented them, things like that have to happen. So I feel like energy and DOGE is the goal to bring costs down, bring inflation down. Certainly that's going to come at the expense of job losses. Like unemployment will absolutely go up. We're absolutely going to have a recession. We'll talk about that a little bit later. But I think the goal is to bring expenses down, bring the debt service down. Once the debt service comes down, once interest rates are low enough and they can refinance this debt at a lower rate, then I think you'll start to hear policies that are a little bit more growth oriented to try to boost employment back up. But I think in the next 6 months, it's going to be a weak economic period of time. I think the president could do a better job of telling people, hey, be prepared, strap in, buckle up. We're going to have some turbulence. But here's why. I don't think he's doing a great job of telling people the why behind it. But in my opinion, the why is we got to get the debt cost down, and whatever it takes to get there is the most important thing.
So if we were to bring this to our living room instead of Washington, D.C., essentially Dave Ramsey says if you have credit card debt and you're spending more than you're making, you've got to figure out how to cut it and trim the fat and stop, go
right.
to ramen and cut the cable and get rid of anything that's excess, we're going to cut, right? Yeah. He says, sell the car and go buy the beater. And then from what I hear you saying, if the Federal Reserve or inflation was low enough, that the interest rates were low enough, then we wouldn't have to make extreme, I say the government would have to make as extreme cuts because they could essentially refinance this thing at the interest rate that doesn't put us into a debt crisis. Yeah. But until that happens, because he can't control that, that's more of the Treasury, then he's got to go, well, currently, then we've got to figure out how to do it. Just like if I wanted to go buy a house, I'd have to figure out how to cut expenses to pay for the interest rate that's going to be higher until it gets lower. And if and when it gets lower, I can afford different things. And I can get the house with the pool or with the neighborhood that I want. And so if I hear you correctly, this harsh cut isn't because he wants to be a bully and dictate what he wants to do. And I'm using very harsh and strong words towards our leaders, but he's not doing it because he resents public parks. He's doing it because he's got to trim anything that he sees as non-essential. Some might argue it is essential, but he's going, I've got to stop getting this debt out there until we can afford to refinance this. Right. Am I hearing you correctly there? And again, this is not a political, right? Whether you think what he's doing is right or wrong is a different personal view. But from a math standpoint, he's doing it for math.
Yeah, I 100% agree. And I think what's unique is most presidents, when they're first elected, they want to be reelected, right? And so what do they do in their first term, right? They do things that don't rock the boat. Well, not rocking the boat means getting into bigger debt problems, but maybe they get reelected, right? And so Bush was guilty of that. Obama was guilty of that. And Biden and Trump were both guilty of that in their first terms. What's a little bit unique now is there's no second term, right? Trump's already had 4 years. This is it. And so I think there's less concern of getting reelected. And then, their second term, they've then become kind of a lame duck and they can't get as much done. So I think there's less concern of, is there public outcry because we think the public good. Now, you can argue the manner in which they're doing things could be a little bit more gentle. But like you said, Rick, right, Dave Ramsey said, eat Robin. Well, we've been eating steak and we like steak and we don't want to give up our steak. We don't want to eat ramen. And so that's a tough thing people have to get used to.
Mm-hmm.
And since COVID, and it's really exploded since COVID, and it started, and the reason why this isn't political is it started during Trump, right? The government spending, government growth, government deficit started during Trump, and then Biden kind of poured gas on the fire. And so, neither one of them did a great job with, keeping our fiscal house in order, during that period of time, either, Trump's term in 2020 and then Biden, a couple years thereafter. So when you look at the unemployment and the employment numbers over the last year or so, around 25% of all jobs that were created were government jobs. Historically, that's somewhere between 8 and 10%. And so we've just become way too reliant on government funding. And it's easy to rely on government funding when they can print money, right? Like I can't print money. Can you print money? I mean, I don't think you have a money machine. I don't have a money machine. Nobody listening to this has a money machine. The government has one. They need to be a little more responsible with that. So, so I think to kind of put a bow around it, it's cut, bring inflation down, no matter how painful that is. That's good long-term. That's going to come at the cost of higher unemployment, and there's going to be people that lose their jobs, and there's going to be some economic challenges. The other side of that, though, is when inflation becomes low enough, I think that's great for the real estate market, because what's held every buyer that you or I have talked to in the last 2 or 3 years, what's held them back from buying a house, whether that's a move-up buyer who was trapped because they have a 3% mortgage or a first-time home buyer, it's interest rates.
It's at least a conversation. And that was my phone call. That was my message to the consumers here last week, was affordability. And I mentioned it like a balancing beam. And when inflation is lower, that means spending is not where it needs to be. And so they make things cheaper, interest rates cheaper, spending goes up. Then they go, oh, inflation's too high. Let's make things more expensive. And we're finding the balance here. Where are we locked in today, Mike? Last week I said this was the national site. It was 6.3 FHA, 6.7 for the conventional.
That's about right. Yeah.
Okay. So we're still staying about there. Would you say this is a pretty balanced market from your 22-year history of mortgage rates?
Where rates are?
Mm-hmm.
No, I think rates are still high historically. And when I say historically, going back like the last, 20, 25 years. Because, in the 80s, late 70s and the 80s, pushing towards the early 90s, rates were significantly higher. But, we've been in about a 35-year run where rates historically are pretty low, like south of 8%. But in my 22 years, a 6.5% mortgage is still about 1.5 points higher than what you've seen as the average over the last 20 years or so.
Okay, so you'd say if you were to put a pin on it, of what would you say is that when I ask that question again, you say, yeah, we're about there. Is it 5.5 or what's that number?
Yeah, 5.5. And I actually saw a study done by Reventure Consulting, who you've probably heard of. They surveyed 1,300 people last year, homeowners, non-homeowners, and they said, at what rate would you get into the market? And 5.5 was the median. So I think when it starts with the 5, I think when you creep into the upper 5s, I think that gets the market charged a little bit. That's why I think there's great opportunities for buyers in today's market, because there is a lack of competition. Like you mentioned in the lead-in, inventory is rising. There's deals to be had that we haven't seen in quite some time. And that's because of lack of buyers. I feel like once rates dip into the 5s, which could happen this year, it'll be interesting to see. I think competition picks up and maybe you start to see prices tick up a little bit in certain markets, and multiple offers probably come back and become a thing again as well.
Well, and the good homes still have it. We've had several buyers who have a specific home in high desirable neighborhood, and they are coming in at or above list price, multiple offers first weekend. So that's still there. Yeah. And then some sellers are still trying to hold on to that number that they want, especially people who bought in 22 and 23 that are accustomed to be able to sell it, to be able to walk away with a down payment, they're coming to cash on the table. So they've got a number in mind that says, I need to sell it for X so I don't owe money. It costs about 10% to buy and sell a house. And if you didn't get that back on equity of at least 10%, which we haven't in the last 2 years consecutively, then they will be a little bit upside down from that down payment. Talk to the public about what is the definition of recession. I believe it's 2 quarters of a lower GDP.
Negative GDP. Yeah.
So break that down for the third grader for me.
Yeah. So a recession basically is you have 2 quarters of economic contraction. And here I'm going to share my screen because I've got a good chart here. Just that kind of highlights the relationship between what the Fed's been doing, which is hiking rates.
Some people might be looking at this. So as you talk about the visual here, to kind of make it a play-by-play announcer, like when you're playing ball.
Yeah, perfect. Okay.
Make it.
So we should be able to see it here. So, okay. So the chart I'm showing, this goes back to 2000, and there's a line that is the Fed funds rate. And so economic cycles go, like you were sharing momentarily a minute ago, Rick, economy grows, things get hot, and the Fed says, we've got to hike the Fed funds rate. We've got to slow things down a little bit. Inflation could be getting a little bit too hot. And that's what happened post-COVID. I remember early COVID, and you probably remember, and you know, one of my former partners, Dustin. Remember Dustin and David and I, my 2 partners, getting together. This is week 1 of COVID, and saying, I don't know how we're going to survive. Like, we may have to shut down. We may have to lay people off. And there was about a 2 or 3 week period of time where we thought it was like, how are we going to close a real estate transaction when people can't see each other?
It was in April of 2020 when a lot of the states, not named Florida, were deemed non-essential. Real estate was still essential, but I would do closings wearing a mask in between 2 people in their vehicle because we still had a social distance. Now, it was a very strange, I'd say weird. 3 or 4 weeks in April there when we didn't know how long we were going to quarantine for.
But that scary time with regard to real estate was so fast. Like, in an instant it was over. Then all of a sudden it was boom, craziness. We went from how can we stay in business to we can't keep up. And it felt like overnight. And so there's economic cycles. And so that the market booms so the Fed cuts like crazy during COVID, right? The Fed thinks we've got to keep the economy open. We've got to cut like crazy. Cutting rates to 0 caused a huge economic contraction in a time where we thought, economically things were going to be perilous. Like, we were thinking this is 2008 all over again. And so then the economy gets really hot. And the mistake I feel like the Fed made this time, and they often make, and it's certainly like, I'm not qualified to be the Fed chairman. That's a very difficult position, but they probably waited too long. So the economy boomed, inflation rose, and then the Fed said, oh my gosh, we've got to hike the Fed funds rate, bring rates up because we've got to slow things down. And so cyclically, you get in these boom and bust cycles. And so the chart we're sharing basically shows that the economic cycle is, after a hot economy, the Fed hikes the Fed funds to slow things down. Then they pause, and then it's stable for a period of time. Typically, that's about 12 months. And then the Fed says, okay, we're starting to see signs of a slowdown. We'll start cutting rates. And right about the time they start cutting rates, you see a recession. And so we've had 3 recessions since 2000, since I've been out of college in the mortgage business. You had one post-dot-com bubble, 9/11 in 2001. You had one in 2008, and then you had a brief recession during COVID. And if you're looking at this chart, the gray lines are the recessions. And you can see the width of those are significantly different. That COVID recession was 30 days, maybe 60. The financial crisis, 2008, was 18 months maybe. I mean, it was long. And September 11th, post-dot-com bubble, that recession was about 6 months to a year, which was just pretty typical. And so what I shared on Facebook a few weeks ago, because, people like to argue, if you're a Trump person, it's all Trump all the time. If we're a Biden person, it's all Biden all the time. And everybody likes to argue on social media and or whose fault is it? And basically what I said on a Facebook post where I shared some market data was the recession was guaranteed 2 years ago. When the Fed started hiking the Fed funds rate, we were going to have a recession It was just a matter of when and how bad. And there should not be nothing that we should fear with the R word, the recession word. Every 5 to 15 years, we're going to have one. That's an economic cycle. It's nothing we should be fearful of. We have to be educated to say, how deep of a recession could we have, and maybe what industries could be impacted positively and negatively. Like generally, outside of '08, real estate outperforms other investments like stocks and bonds. Real estate performs well during a recession because it's essential. The stock market typically will take a hit during a recession because businesses are contracting, and the value of a business, and like a stable long-term business like Disney or AT&T or General Motors, they shrink during a recession because people aren't spending money buying cars or going to Disney World. So
I want to point something out here as well. This is an interesting chart here. Because I remember this in 2020 and 2021, we said that Federal Reserve's to zero and interest rates are then around 2.5 to 3. And so the interest rates are usually 2.5 to 3 points above Federal Reserve, right? And so,
not necessarily. Not necessarily. They're usually 2.5 to 3% above the 10-year Treasury, which is much more stable.
Okay.
And so the 10-year Treasury has been kind of in the mid fours this year. It's gotten into the low fours, gone up to the high fours. That's why you've seen mortgage rates, 6.25 to 7. So the Fed funds rate.
So that's not this. This is more concerning the number.
Correct.
That's going to meet or counterbalance.
And this is where I mentioned earlier that you've got to get the right information. So when the media says the Fed cut the Fed funds rate, people think that means my mortgage rate went down. It could not be further from the truth. There's no direct correlation between the Federal Reserve and mortgage rates. Now, indirectly, if the Fed's cutting, mortgage rates are probably going down. If the Fed's hiking, mortgage rates are probably going up because they go up for the same reasons, generally speaking.
But it's not a direct correlation.
Yeah, not a direct correlation. Yeah, okay. But like mortgage rates are down. Actually, this past fall, the Fed cut the Fed funds rate a point. It went from 8.5. Well, it went from 5.5 to 4.5, which meant that the prime went from 8.5 to 7.5. Mortgage rates went up this fall, actually, after the Fed cut. So now it'll even itself out, and now they've gotten moving in the same direction, but it's not a direct correlation; it's indirect.
Well, the other thing I noticed, and if you're not watching but you're listening, is the table that we're looking at. It almost went straight up from 15 up to 20. It was a nice gradual climb, and then COVID hit, and that was the no, we're going to have a recession and a global shutdown, and let's make money cheap so people keep spending money. And then we did too much, to which they said, pump the brakes, and they increased it and shot up in 2022. But if you look at the table here, it looks a lot like 04, 05, 06, 07. And if that's the case, we're sitting at about the same time as 07, which was the beginning of the Great Recession. Now, do you feel that we are destined to repeat the Great Recession that we saw 15 years ago?
Yeah, I don't think we're going to face anywhere near the degree. And that recession was really caused by real estate. And it was caused by real estate for a number of factors that aren't in play today. So today, 7%, 8% of all mortgages are adjustable rate mortgages. Back then, it was about 40, 45%. So you had a lot of people that had mortgages that were resetting. So that was certainly a big cause. And then the average homeowner today has a loan amount that's 28% loan to value ratio, meaning they owe $28,000, their house is worth $100,000. Prior to 2008, the average was 70%. So people were more than double leveraged back then compared to where they are today. And about 80% of all people with mortgages have an interest rate below 5%. 30% of all homes are free and clear. So the general public, is nowhere near leveraged, both with dollar amount and the type of loan that they had prior to 2008. So most recessions are economic cycles. Like this recession will not be caused by real estate at all. It'll be caused by the post-COVID boom. Inflation went up. The Fed hiked the Fed funds rate to slow things down. That's why we'll have a recession this year. Same reason why we had it in 2001 and in 1991. The 08 crash was 100% caused by a real estate bubble, speculation, adjustable rate mortgages, liar loans, all the things that we heard about back then. If you watch the movie The Big Short, that movie is 100%
Wow.
accurate. Yeah.
Well, and I'm glad you mentioned that. It's funny because you talked about the over leveraging and types of loans versus that's when I got into real estate in 2010. 80% of the inventory was a short sale or foreclosure.
Yeah.
And it was just every fourth person had experienced it and was going through it. Loan modification, short sale seminars, one of the best lead generation tools. Yeah. Knocking on doors and saying we can sell your house without the expensive fees because the bank pays for it, right? And it's just a different market. And the biggest thing is we mentioned earlier on the call that we have 12,000 homes for sale and 2,000 selling. And back in 2011, we had 28,000 homes for sale and 700 selling. Yeah. With about 35 months. And that's where we saw just the decline, that people had a leapfrog in front of it. Right now, we are seeing a steady increase. We saw 4 consecutive months, the end of last year, with a declining median price point. And then we're seeing that increase again. I think we're much more seasonality, that we're going to see a strong Q2, strong Q3, a slow Q4 or a decline Q4, and a flat Q1. Are you seeing the same thing in your mortgage side from loan approvals or authorizations or credit pulls?
Yeah, like from a transaction pre-approval lead standpoint, we're very busy right now. I'm a little bit surprised. Most of the clients that we're working with today are people that have called us in the last 60 days. I expected that a lot of the business we'd be doing now were people that we pre-approved in 2023 and 2024 that haven't purchased yet, that didn't purchase in the past because of affordability challenges. I thought they would be coming back to a greater clip than they are. Those people don't seem like they've totally re-entered the market yet. And there's differences in different price points. Like where I live in Winter Park, there's been houses in my area that, and you mentioned multiple offers, like $3 million house, one day in the market, 4 offers, all cash. Like that's a different kind of buyer. And so different pockets of the market, different price points. I think
versus condos versus the short-term rental market down in Kissimmee area is just getting crushed right now with saturation inventory.
We got hit, Rick, with for the first time in a number of years, and you probably remember this from like 2010, 11. So we had an appraiser mark that a market was a declining market. It was in Kissimmee, and it was in a short-term rental area. And I haven't seen an appraiser mark. So for those watching, appraisers can mark like stable on the appraisal, meaning the market's stable or appreciating. That's typically what we've seen. Literally every appraisal I've seen for the last 15 years said stable. We got one this week that said declining. And it's someone buying a short-term rental, DSCR loan, and they marked declining. And so that's the first time I've seen that in many, many years. And I think we'll see more of that. But yeah, certain pockets where there's a lot of inventory.
So as we look at that, and you're speaking with your lender or your real estate agent, it's very hyper local. We're giving you very macro numbers, then every different pocket from Winter Park to Oviedo to short-term rental to condos are going to have different areas. So as we wrap up this call, I want to ask you to pull your crystal ball out and talk to that buyer, that seller, that investor of going, what does 2025 look like in terms of inflation, of recession, of interest rates, and how will that impact the real estate market? What's your crystal ball prediction of what's going on in real estate this year?
I think prices are going to be relatively flat. I think you could see a couple percent appreciation or depreciation in certain pockets. I think nationwide, the Case-Shiller Index will probably still show positive because the market's stronger up north right now because it's been weak for a number of years, where in the South, Texas, Austin, Texas is probably the worst market in the country right now. Wow. Things are softer. But I think nationwide, you're going to see, 2-3% appreciation. In Florida and certain markets, you're going to be probably between like -5 and +3, maybe. In certain markets, I think interest rates are going to continue drifting lower, but it's not going to be a direct line down. It's going to be a stair step. Like rates are up today. So if you turn the news on, you might hear that rates went down last week, but I'm telling you today on Monday, rates went up today. And so it's not going to be straight down. It's going to be straight, flat, up a little bit. But I think, if rates are in the 6.25 to 6.75 range, depending upon the loan program and FICO and discount points, I think rates will get into the 5s at some point this year. We got really close to it last fall before inflation spiked a little bit. Mike, I do think you're going to see unemployment tick up a little bit. I think they'll call that we're in a recession probably in the third quarter and they'll probably say we started in the first quarter, because usually when they identify that we're in a recession, it's usually 1 or 2 quarters after it actually started. So I think the recession has already started, and I think it'll be reported in July. And that'll bring rates down.
But overall, people who are on the fence and waiting for something that's kind of here. We're not expecting anything drastic. What you're seeing right now, you'll get a little bit of hyper-local sway, a little bit of seasonality sway. Last year, and the prediction was pretty spot on. I said we're going to go up about 8 points and down about 4 in the fourth quarter. And that was about what the market did, which gave us a net growth of 4% year over year. You think it might be even less, maybe up 6 ticks of median percent points, and then down 4, maybe flat to up 2 or 3, which is about what we want. Historically, we've been tracking it since the 1970s. Not me. I wasn't born in 1970. Still a young guy. I'll put that on there. Not that young, though. But it's been a 4% growth in real estate has been that trend line. And it was a steady incline until 2005, when it went way up and then way down. Actually, it looked a lot like your Federal Reserve chart there. That's what the market was doing. We are finally getting back to healthy, and then COVID hit, and then it went way down for like 4 months and then way up for the last 3 years. And when people ask me now, how's the market? I say it's the most predictable market that I've been in the past 5 years, with seasonality kicking in, because COVID really threw seasonality out the window. All bets were off. People were buying it because why not? People were refinancing the house because you were silly if you did it. My brother refinanced his house, I think, 4 times in 5 years, because he had 5 and 4 was great. And then 4 was great and 3.5 was better. And now he's sitting at 2.75. And he would be crazy to ever sell that and trade it in for 7% right now. And that's where we're at right now. People who still need to move are moving, and it's not that bad because prices have also calmed down with it. When interest rates were 3%, you were paying $50,000 above appraised value just to get into it. So you kind of, if that were to happen again, prices are going to spike up and your affordability becomes a problem. So I love that it's gradual. It's a lot more stable, a lot more predictable, and the whiplash was just giving me a headache. So I'm glad I'm at where we're at. Any final or parting words or thoughts as we wrap up this call here?
So one point, Rick, and we mentioned this earlier, and I have a chart, but I don't need to share it. But there was a chart I saw over the weekend, and it was a salacious headline that delinquencies are exploding, basically, is what they said. And it was on Twitter. And the person who posted it is pretty reputable, and I follow them. I just didn't like what they posted because they made it seem like delinquencies on houses are skyrocketing, which they're not. Delinquencies are actually less than they were pre-COVID in 2018 and 19. And the chart they showed was multifamily delinquencies, and it had increased from 0.1 to 0.4%, which is still historically low. And so they took this little sliver of data, they made it seem much worse than it was, and then posted it. And they actually got community noted. And for those who are paying attention, don't know what that means, on Twitter, if you post something that's inaccurate, the community on Twitter, X, can basically comment that that's inaccurate. They can supply data. And if you're some type of influencer, public persona, and you get community noted, it's pretty embarrassing. That's basically telling the whole world that whatever I posted was wrong or misleading or inaccurate. And so I was glad the public pushed back on this person because it was inaccurate, but it was a great example that you have to find trustworthy news sources that aren't skewed one way or the other, whether that's the market's great or the market's terrible, or vote Republican or vote Democrat. You have to find news sources that are reliable, that aren't skewed one way or the other. And so hopefully that's what we provided today. And if you do find something that's a little bit misleading or inaccurate, push back on the news you get and dig deeper, because a lot of times the surface level stuff is for the headline. Like this,
it's for the clickbait, right? Something to get you to click on it and then sell you something or persuade you something. No, I love that. And I think the conversation, if people are still with us, then they must be really economically or really love one of the two of us right now, because we talk some pretty in-depth stuff, right? The entertainment factor was not there on this call. It was the education factor. So if you guys are still with us and you heard this, whatever meeting you heard it in, thanks for sticking around. If you have any more questions, Michael, I think the best way I'd like to point them to you is going to be your Facebook page, because every Monday you do that live Zoom call with that Monday market update, and they can just follow you. Michael Smalley, Smalley, his name's right there. find them on there. It's your personal page, and that's where you post it, and you post the link for it. So you don't broadcast it afterwards. So if you missed it, you missed it, right? It's live or bust. You don't get the recording.
It's live, yeah. We're working to record it and post it to a YouTube page ultimately, but yeah, right now it's on there at 10, and
Okay.
if you miss it, you miss it, and get us next week.
Okay, we'll get you next week. Well, I appreciate you jumping on and adding value to my audience here, and hopefully they found value. And if we can ever help you out and you guys have any questions around the mortgage industry, then there's Michael over at CrossCountry, Regional VP and servicing the greater Orlando area. So love to support you there as well.
Thanks, Rick.
Thanks, bud. Appreciate you. Bye-bye. All right, guys, thank you for listening. And if you have any questions, make sure you reach out to whoever sent you this email, one of the agents on our team or myself directly. You've got all for information, or you can also follow us on any of the Facebook, the YouTube, the Instagrams, the TikToks, and everything else out there, because the world is just full of information, and we're glad that you heard a little bit of it today. Thanks so much, everyone. Have a great day. Take care.